The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. Thank you for joining us today for our webinar on personal carers leave and annual leave. For our webinar today, we have muted all attendees, so you're in listen-only mode. If you have any questions, please use the chat box in the control panel displayed on your screen at any time during the webinar. We will look at trying to answer some of those by the end of the session. If not, we will come back to you later on as best as we can. Today's webinar will be recorded and you will receive a link to the recording after the webinar. My name is Angela Lehmann and I am the MC for today. I am the Legislative Manager at ADP and I will also add a little bit of discussion around the tax implications relating to our topic today. We are joined by David Bates, Managing Director of Workforce Guardian, our alliance partner. Welcome, David.
Hi Angela, how are you going?
Good, thank you. I guess what I'll do now is I'll hand over to you and let you get us started.
Perfect. Thanks very much, Angela, and g'day everyone. Welcome along to today's webinar. It's fantastic to have your company. There's so many of you that have joined us for this webinar. It's fantastic. Really do appreciate you taking time out of your busy day to join us for this webinar. For those of you who might not have attended webinars before, just a heads up that I'm broadcasting from Sydney, where my colleague Angela is broadcasting from Melbourne. So we really are in the 21st century here. And so we'll be bouncing backwards and forwards through the webinar as we go from topic to topic. Now, what you're seeing on your screen is an overview of the material that we'll be covering today. And you can see that the focus is all about two specific types of leave. And both of these forms of leave, of course, come from what are known as the National Employment Standards, or NES for short, which are in turn found within the Fair Work Act of 2009. So we've effectively divided the webinar into two parts. In the first part, we'll be talking about personal carers leave, and specifically we'll be discussing who's eligible, the fact that personal and carers leave is in fact interchangeable. We'll talk about how it accrues, your right to request evidence as an employer of an employee's need to take leave. We'll discuss the implications of leave being taken in advance of its accrual, and then Angela will discuss the tax considerations that are associated with personal carers leave. In the second part of the webinar, we're going to talk about annual leave, something that we all love. We all love annual leave, very popular here in Australia. We'll be talking about who's eligible to take annual leave, how annual leave is accrued, when and how annual leave can be cashed out. We'll talk about, again, leave being taken in advance of its accrual, and once again, Angela will then jump back in to talk about the tax considerations that relate specifically to this particular form of leave. Webinar, we're going to have just a final word about fraud, what you should do if you suspect someone in your business is engaging in fraud relating to personal carers leave or annual leave. So at the end of the webinar, you should have a really good, clear understanding of these two key NES entitlements. Now, just before we go any further, it's important just to point out, especially today, because so many of you are joining us from Western Australia, it is important to point out that what we're discussing today are the leave entitlements that are derived from the Fair Work Act. Now, in every part of Australia, apart from Western Australia, private sector businesses will almost absolutely certainly be covered by the Fair Work legislation. So what we're discussing today will be directly relevant for you. If, however, your business or another business that you're dialing into today on behalf of, if that business is based in Western Australia, and if that business is not an incorporated entity, such as a proprietary limited business, then in fact that business will be captured by Western Australia's own state-based industrial relations laws. So Western Australia remains the only country still operating a state-based industrial relations system for private sector businesses, but again, that state system only applies to non-incorporated entities. So sole traders or unincorporated partnerships, for example, are in fact captured by WA legislation. So for the purposes of today's webinar, what we were discussing really only applies in WA to businesses which are incorporated. So let's just talk about these 10 national employment standards for a moment, because as I mentioned a few seconds ago, it's from the national employment standards that these two particular types of leave are derived. So you can see all 10 of the national employment standards now on your screen, and you'll note that most of them are in fact to do with leave-related entitlements, but certainly not all. If you see there in the top left-hand corner, the maximum ordinary working week, that's set at 38 hours. In the bottom left, we have notice of termination and redundancy pay. In the top right, requests for flexible working arrangements, which is an entitlement that belongs to certain eligible employees covered by the Fair Work Act. And in the bottom right, we have the Fair Work Information Statements, which are the documents that have to be issued by an employer to all new employees who've been hired since the 1st of January 2010. So those 4 entitlements are not leave-related entitlements at all, but the other 6 certainly are. And of course, it's within those 6 that we have personal carers leave and annual leave. Now the key point here to note, of course, is that those 10 national employment standards apply effectively to all private sector employees in Australia, and in WA, as I mentioned, they certainly apply to businesses that are incorporated. So they are minimum terms and conditions of employment that must be provided to all eligible employees. There's no legal ability to contract out or to bargain away any of those 10 national employment standards. Effectively, they apply as a matter of law and they have to be adhered to. So let's start with personal carers leave. Well, the first thing to note is that employees accrue personal carers leave progressively throughout the year of service. What that means is that an employee doesn't accrue all 10 days from the moment they start, nor can they be denied the accrual until they're finished a probationary period or any other form of minimum employment period. As soon as an employee begins work, and provided that employee is not a casual, they will begin accruing personal carers leave right from day one. Now for a full-time employee, they must accrue 10 paid personal carers leave days per year of service. A part-time employee will accrue this form of leave on what's called a pro rata basis, based on the number of hours that they actually work, and that is ordinary hours that they actually work. So a part-time employee working exactly 2.5 days per week would accrue 5 days of paid personal carers leave at the end of each year of service. Now, in addition to personal carers leave, there is actually a separate entitlement which is called compassionate leave. So it's really important to note that compassionate leave applies on top of personal carers leave. But personal carers leave itself is interchangeable. You can take a day as personal leave or a day as carers leave. But in addition to those 10 personal carers leave days, which are accruing each year, the employee also has access to up to 2 days of compassionate leave when that form of leave is required. And compassionate leave can be taken by an employee whenever a member of their immediate family or household experiences a life-threatening illness or injury, or in fact passes away. For all employees other than casuals, this form of leave is paid. Casuals are entitled to unpaid compassionate leave. Now, as we've noticed, there are 2 distinct types of leave here, personal leave and carers leave, even though those terms are interchangeable. So, an employee is entitled to take a personal leave day if they are ill or injured and they are unfit for work. Now, most employers clearly understand that an employee can take personal leave when they're ill or injured. But many employers don't realise that this second requirement must also be met. That is, that the employee is unfit for work. Now, the reason that this is important is because if an employee was to come to you, for example, and ask you to take personal leave so that they could attend a routine checkup, well, technically, they're not entitled to take paid personal leave for a routine medical or dental checkup because, of course, they are not necessarily ill or injured and they are otherwise fit for work. Now, in those circumstances, you could say to the employee, really, you can take annual leave or you could take leave without pay. But in order to access personal leave under the Fair Work Act, the employee must be both ill or injured and otherwise unfit for work, mainly as a result of that illness or injury. Okay, so now we're going to talk about the eligibility. The first thing to note here is that a member of the employee's immediate family or household must be ill or injured or experiencing an unexpected emergency, and they must require the care support of your employee. Angela, I can hear that you're just back on the line.
Hi.
Hi, did you have something, did you have a question maybe that you were jumping back on for?
Sorry, David. I think that was actually a bit of a technical difficulty there. Sorry.
Okay, no worries. This is the beauty of broadcasting from two different cities and us not being able to see each other.
Yeah, sorry. Please continue. Sorry, I do apologise.
Yeah, no worries. All right, so we're just talking about the eligibility criteria for taking carers leave. So as we said, the first thing here to note is that a member of the employee's immediate family or household must be ill or injured or experiencing an unexpected emergency, and it's the employee that must be required to care or support for that employee. In those circumstances, they'll have the ability to then access carers leave. So we know that personal leave is when the employee, him or herself, is ill or injured, and we know that carers leave is when the employee needs to take care of a member of their immediate family or household. Now, personal and carers leave, as I mentioned earlier on, are in fact interchangeable. So the type of leave varies depending on the specific circumstances that the leave is being actually taken for. So the 10 days is interchangeable. 8 days of that could be taken, for example, might be taken as carers leave. However, it can be taken in either form of leave depending on the reason that the employee is going to be absent. Now, when it comes to accrual, we've mentioned that a full-time employee accrues 10 days as a minimum per year. Part-time employees are accruing this on a pro rata basis. And remember that casual employees have no entitlement to accrue paid personal carers leave. Instead, casual employees receive what's known as the applicable casual loading, which for most casual employees is set at 25% of the base hourly rate. Part of the reason that casuals receive that amount is to compensate them for their lack of access to personal carers leave. Now, here are some key points that you need to know about personal carers leave. The first is, as again we've emphasised at the beginning of this section, it accrues right from day one of employment. The second is that there is no set annual limit on the number of personal carers leave days that can be taken. However, the employee, of course, has to actually have those days accrued. So sometimes we hear people talk about 10 days of personal carers leave per year, and employers mistakenly assume that means an employee can only take 10 personal carers leave days per year, but that's not the case. For example, if an employee is full-time and has worked in your business for 2 years and has never taken a personal carers leave day, they'll have 20 days accrued. If they then became very sick, they might actually need to take all 20 days. So there is no maximum of, say, 10 days per year. That only relates to the accrual. If they have a higher number of days accrued and they need to take those days, they can. And of course, if they needed to take instead 20 days to care for a member of their immediate family or household, they would also be able to take 20 days of carers leave. But remember, it's one or the other. They're not cumulative on top of each other. So we're accruing 10 days of combined personal carers leave days per year, not 10 days of each. Unused annual leave also rolls over from year to year. Another common mistake that employers make is they reset an employee's personal carers leave balance to zero on the anniversary of the employee's employment. But you cannot do that because the Fair Work Act expressly states that unused leave has to roll over from year to year. So again, going back to that example I gave you just a moment ago, a full-time employee who's never taken any any personal carers leave for at least 2 years, if they're full-time, they'll have accrued 20 days. And at the end of the third year, if they still haven't taken any personal carers leave, they'll then have 30 days and so on. Remember that unlike annual leave, personal carers leave is not paid out at the end of employment, so it's not really a liability that you're having to worry about. Now, one of the most common questions we get asked at Workforce Guardian from ADP is, can I ask an employee to prove that they were in fact sick or that they needed to care for a member of their family or household? And the answer to that question is yes, absolutely. And there's no restriction as to when you can ask for evidence. So some employers, again, mistakenly think the employee has to have been absent or that the absence has to have been on a day that coincided with the weekend or a public holiday. But that's not true. The Fair Work Act allows you to ask for evidence whenever an employee is absent and is requesting access to leave. And that evidence can be generally in the form of a medical certificate or a statutory declaration. They're by far the most common types of evidence that employers request. Now, once an employer makes the request, and remember it's only when the employer has specifically made the request, the employee then needs to provide that evidence. Once they've replied or provided that evidence to the employer, the period of absence can then be treated as paid leave, and it can be assigned appropriately to whether it's personal or carer's leave. Now, if the employee refuses to provide the evidence after receiving a specific request, then the employer is entitled to treat that absence as unpaid leave, and that would mean that there is no deduction from the employee's personal carer's leave balance at all. The employee is simply regarded as being on unpaid leave. Now, many employers decide to provide personal carer's leave in advance of its accrual. So they might have a fairly new employee who hasn't yet accrued much personal carer's leave, and that person gets sick, takes a day off, but actually they don't have enough paid personal carer's leave to cover their absence. Well, although employers certainly can provide leave in advance if they want to, we strongly advise against it because it's virtually impossible to recover that leave debt if the employee was to end their employment before their leave balance goes back to zero. So although you can do it, we strongly recommend against it. And remember, it would be unlawful to recover a personal carer's leave debt by making a deduction directly from an employee's final pay. You cannot do that. So again, getting the leave that's been paid in advance back if the employee leaves before it's been accrued back to a zero balance is really tricky. So for that reason, we don't recommend you provide leave in advance of its accrual. Okay, Angela, now I'm handing across to you to discuss the tax implications.
Thanks, David. I think with tax it's always a little bit complicated because tax considerations may fall by the wayside at times, and people just assume that it's treated exactly the same way as they would in their normal salary and wages at all times, and that's not necessarily the case. So for unused personal leave, when you pay that out upon termination of the employee's employment, then it does actually form part of the ETP or employment termination payment. So it actually gets treated the same way as a golden handshake or any other type of termination payment. It's subject to either the ETP cap or the whole of income cap because of the type of ETP that it is. It's also included in the payroll tax definition of wages, so it actually does impact your payroll tax balance. The only good thing, I guess, you could take from it is that there is no superannuation guarantee, or SG, as most of you would know it as, the 9.5% of employer contribution. So it's just important to know it is an ETP. It's a non-exempt portion for those of you that do the tax part of these types of payments, and that is for all states and territories. It is included for payroll tax purposes. So just a little bit of a warning, I guess, more so than anything else, just to consider when you are taxing a final pay that you consider these elements.
Brilliant. Thanks very much for that, Angela. You're reminding me why I don't like dealing with tax. I'm glad to be working with you.
Not that our employment law and Fair Work standards are much easier.
That's right. Maybe I'm just more familiar with them.
Exactly, exactly.
Well, there's no I in team, and that's probably exactly why the Workforce Guardian and ADP partnership works so well. Each sort of, I suppose, playing to our strengths. So thanks very much for that, Angela. Much appreciated. All right, so we'll come back to you again very shortly when we get on to the tax implications for annual leave.
Yeah, great. Thanks, David.
All right, so now moving on to the second part of our webinar. We've now talked about personal carers leave or sick leave and carers leave, so slightly depressing part of the topic. Let's talk about annual leave. Everyone loves annual leave, going on holidays. So who is in fact eligible to accrue annual leave? Well, again, just like personal carers leave, all employees other than casuals accrue paid annual leave. And again, just like personal carers leave, it accrues progressively throughout the year of service. Now, taking of leave, actually getting approval to go on leave, it does require mutual agreement. There are some certain circumstances in some modern awards or enterprise agreements where an employer has the legal right to direct or compel an employee to take some of their annual leave. But again, those circumstances are very specifically limited. There is no general entitlement on an employer to be able to direct employees to take annual leave. We always need to go back to the applicable modern award or enterprise agreement. And if we just stick on this point about mutual agreement being required, what that generally means, for example, is that if an employee has used up all of their sick leave, but they are still sick and they want to remain receiving payments from the employer, they may ask the employer to access their annual leave balance. Now, an employer is not generally required to approve that application. So an employer can say, no, look, annual leave is for when you're going on holiday, you've used up all of your personal leave, so now your leave becomes unpaid. Now, that said, many employers would provide access to annual leave in those circumstances, but it really is up to you. You have that discretion. Now, again, a moment ago I mentioned that just like personal carers leave, annual leave is accruing progressively through the year of service, and for full-time employees, the maximum and minimum, really, amount of annual leave that's accrued each year of service is 4 weeks. Now, what that means is that a full-time employee, after finishing 12 months of service, should have accrued 4 weeks of annual leave up their sleeve. Now, remember again that annual leave accrues in relation to an employee's ordinary hours of work. So if a full-time employee was to do a whole bunch of overtime, they wouldn't then accrue more than 4 weeks of annual leave per year. The only time an employee accrues more than 4 weeks of annual leave per year is if they are a shift worker, or under certain modern awards, the employee's entitlement is increased. So for example, a nurse who is covered by the Nurses Award 2010 is entitled to accrue a minimum of 5 weeks annual leave. And if that nurse happens to be a shift worker, they in fact accrue a minimum of 6 weeks annual leave. So you can see again how the modern awards and the national employment standards always need to be read in conjunction with one another. Now, for part-time employees, again, just like personal carers leave, this particular form of leave accrues on a pro rata basis. So once again, if an employee is part-time and they work exactly 2.5 days per week, then at the end of 12 months of employment, they will have accrued 2 weeks of annual leave if they are entitled to an accrual equivalent of 4 weeks for a full-time employee. And again, a casual employee does not accrue this form of leave. And once more, we see that that 25% casual loading effectively compensates employees for their lack of accrual of annual leave. Now, once more, we see that this form of leave accrues right from day one. And again, just like personal carers leave, there is no set annual limit on the amount of annual leave that can be taken. But once again, the employee does need to have it accrued. So if an employee has been employed with you for 2 years, is full-time and has never taken any annual leave, they should have 8 weeks of paid leave minimum up their sleeve. Now, unused annual leave rolls over from year to year, and so that will continue to accumulate. And then, of course, if the employee wants to take a whole chunk of that, just like every time with annual leave, it is subject to the employer's mutual agreement. Now, one way that annual leave differs importantly from personal carers leave is that annual leave must always be paid out when employment ends, regardless of whether it's as a result of a resignation or a dismissal, including serious misconduct or instant dismissal. Annual leave is effectively a guaranteed entitlement that must always be paid out. Now, also worth noting that if the employee is entitled to receive leave loading when they take annual leave, they are also required to have that annual leave loading added to the payout of annual leave when employment comes to an end. Many employers get that wrong. They might look at a modern award, and there are quite a few modern awards around, which specifically say that annual leave loading is not added to a payout. But I can assure you that it always needs to be if the employee would have been entitled to it had the leave been taken. This is just one of the examples where the Fair Work Act is quite confusing because the Act overrides that inconsistent provision in the modern award. Now, a very common question that the Workforce Guardian from ADP team receives is, can I cash out some or all of my employees' annual leave? Well, the very first thing you need to consider whenever you are considering cashing out any of an employee's accrued annual leave entitlement is whether that employee is covered by a modern award or an enterprise agreement. Because if the employee is covered by a modern award or enterprise agreement, cashing out can only occur if that award or agreement expressly allows it to happen. If the employee is award or agreement free, that is not covered by either an award or an enterprise agreement, or if they are covered by an award or an agreement that does allow for cashing out, then 3 strict rules apply. But before we get to them, it's really critical just to remember that you can only cash out annual leave for an award or an agreement covered employee if that award or agreement does indeed expressly allow it to occur. Now, once you get past that initial threshold, the 3 rules that apply are these. Firstly, the employee must have a minimum of 4 weeks annual leave left after the cashing out has occurred. So if an employee has 7 weeks of annual leave accrued, they can't have 4 weeks of it cashed out because then they would only be left with 3 weeks. That 4-week buffer must always remain after the cashing out is complete. Secondly, the agreement to cash out must be recorded in writing each time a cashing out is agreed. So it must always be put in writing and then kept on file. And thirdly, the amount paid out must be the same as the employee would have received had they actually taken the leave. So once again, just like we saw with annual leave being paid out at the end of employment, annual leave that's cashed out will also need to have the annual leave loading paid on top of it if the employee would have been entitled to receive leave loading had the leave actually been taken. Now, we talked a few moments ago about employers providing access to paid personal carers leave in advance of its accrual. Well, in exactly the same way that we advise against that, we also advise against allowing employees to take annual leave in advance. We really strongly feel that annual leave should only be granted where the employee has that leave already accrued. However, unlike paid personal carers leave where there is no ability of a paid amount from the employee's final pay, there are many modern awards and enterprise agreements that in fact expressly allow an employer to make a deduction from an employee's final pay in order to recover any overpaid annual leave. In other words, annual leave that's been given in advance of its accrual and which hasn't been accrued back to a zero balance by the time the employee does in fact end the employment. But remember, this type of deduction can only be made where the employee is covered by one of these awards or agreements which does expressly allow that deduction to occur. In all other circumstances, there should not be a deduction for overpaid or annual leave that has been paid in advance of its accrual. Angela, back to you for some tax considerations relating to annual leave.
Thanks, David. And let me just say I'm so glad we're covering this today because it's amazing how many times with both the cashing in of leave and leave in advance of accrual, we do get clients and queries about, well, surely if we just put it in writing between us and the employee, then it's sufficient. And giving consideration to the awards and what they actually legally are allowed to do often gets overlooked, and that a simple agreement isn't enough just to make the problem go away. So I'm really glad you've covered this in detail today because it seems to be a common misconception. So I'm hoping everyone's really getting a lot out of that. Tax considerations. So I think annual leave is a bit more interesting in that I've seen this done incorrectly a lot. So unlike personal leave, annual leave is actually not considered a ETP. So I'm talking about annual leave paid out on termination now, so as a lump sum. And that actually is the same for annual leave, long service leave and leave loadings paid on termination. They do not form part of your ETP. So if you have made your employee genuinely redundant, you can't apply the concessional treatment that the redundancy calculation allows for or any of that. It actually is a totally separate tax component, so please be aware of that. And therefore it should not appear on an ETP payment summary or anything of the like. There is a specific tax table that the ATO produces or publishes which applies to lump sum leave payments made on termination. They colloquially refer to it as Schedule 7. So if you search that on the ATO website, I do hope you find it. Their website is a bit hit and miss at times. It is also a form of concessional tax rate, but it is not ETP. So please don't apply it to your ETP calculation. You do not have to, and this is a bit morbid, but you do not have to withhold from lump sum leave payments that you make upon the death of an employee. So if the unfortunate circumstances of an employee's passing happens, you do not have to withhold on that lump sum. So the tax treatment is completely different. And then I guess the other point I'll make on lump sum leave on termination is that it is specifically excluded again from the definition of ordinary times earnings, which is the base we use for super guarantee. So again, it does not require the mandatory 9.5 super contribution. So those are my key points on termination and paying out lump sum leave balances. The other thing with annual leave, obviously, is the tax considerations for continuing employees, so employees who just take their leave during employment. You must add any annual leave, leave loading entitlements and long service leave to the total leave amount when you're calculating the required withholding. So it's a total leave balance. When the leave is taken in ordinary course of employment, leave is taxed in the same way as salary and wages. So if you are familiar with payroll and withholding tables, you would use the same weekly, fortnightly, monthly, etc. Tax tables you would use for payroll purposes. And again, in all states and territories of Australia, these leave payments are included as remuneration or wages for payroll tax purposes, so it will impact your payroll tax return. So please be aware of that. The only exception to the SG rule is leave taken during the course of employment and paid through the normal payroll is OTE, sorry, ordinary times earnings, and SG will apply, so you apply the 9.5%. So just based on when you're paying it, whether it's on termination or during the course of employment, be aware that the tax obligations may differ. I guess that's probably the main tax considerations for annual leave. We hope that you found this session very helpful and that you are able to take away some really key points on these topics. We have some numbers on the screen. I think they should be coming through now. If you would like to speak to someone at ADP about ADP and subscribing to Workforce Guardian, please call the 1800 number, 1800 000 729, and we can talk to you about the subscription options there, and we can give you some help with your HR and employment law issues. For our existing ADP clients, please do not forget that you actually have access to the ADP advice line at any time on the 1300 number. David's team is on the line all the time and happy to take your calls and assist you with these matters. So anything else you wanted to mention there, David?
No, not at all, Angela. I think that was a really great session because we were able to cover off, I think, two sides of the same coin when it comes to these leave entitlements, because I know a lot of the time, we get the inbound inquiry about tax considerations, which of course our team just can't answer. And then on your side, your team is receiving questions about accrual and eligibility, which your team is not necessarily best placed to answer. So the idea of today's webinar, I think, has actually worked out really well in that we've together been able to provide answers to some of these really common questions about these forms of leave. So it's certainly been a pleasure to co-present with you, and here's hoping that we can present some more webinars through the year.
Yeah, thank you, David. We really appreciate your time and all your wonderful, valuable advice today. And thank you, everyone, for joining us online. And we'll endeavour to answer any questions that have come through during the session via email. Thank you very much.
Thanks, everyone.